Hi, I'm Steve Brice, Standard Chartered's Global Chief Investment Officer. The first half of 2025 has been volatile and filled with unpredictability for markets. Liberation Day and geopolitical tensions took centre stage and fueled global uncertainty. A weaker US dollar was also something investors had to grapple with. Yet global markets have proven surprisingly resilient, shaking off the concerns around tariffs, Middle East tensions, and US policy shifts. The second half of the year may be shaped by US tax cuts, trade deals, and business deregulation. The recently passed $4.5 trillion US budget, as well as trade deals with key US partners, should help reduce uncertainty and support growth. However, rising fiscal deficit and debts are likely to keep the US dollar under pressure. Amid the noise, our Signature CIO strategies continue to deliver positive returns. Diversification remains key, providing resilience and adaptability. The key question on everybody's mind is the US dollar's dominance fading? The dollar has long underpinned global trade, reserves, and capital markets, supported by deep liquidity and institutional strength. But things are evolving. A shifting geopolitical landscape, rising fiscal challenges, and the gradual regionalisation of trade are prompting investors to reconsider their reliance on the greenback. Despite these challenges, there's still no real alternative to the US dollar. Even with discussions around a multipolar world, the dollar still dominates trade between advanced economies and emerging markets. That said, more emerging market countries are trading in local currencies, and foreign holdings of US bonds has slipped to around 30%. Though there are still limited signs of broad-based selling, the US may need to offer more attractive yields to keep global capital flowing as government debt issuance rises. Against this volatile backdrop, how are we positioned? First, we're overweight global equities. Policy easing worldwide, a strong likelihood of a soft landing in the US, and a weaker US dollar are supportive of risky assets. We favour a diversified global equity exposure and have upgraded Asia ex-Japan equities to an overweight. Second, we expect a weak US dollar will benefit the euro, yen, and sterling. History shows dollar weakness is a positive for equities and outperformance of non-US equities in particular. Within bonds, we favour 5 to 7 year maturities in US dollar bonds and upgrade emerging market local currency bonds to an overweight. And third, renewed tariffs, inflation, and weaker economic data are key risks. Gold is an attractive diversifier that can help mitigate short-term volatility. As we look ahead to the second half of the year, we must keep a close watch on the evolving landscape. A well-diversified portfolio remains your best tool to navigate what's ahead with confidence. Thank you for joining me for this monthly CIO Signature Strategy Update. I'll be back with more positive updates in the next month. We'll see you then.